There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Welcome back to the Trading Justice Podcast. My name is Matt Justice. My brother is not going to be joining us today because I got a special treat for the Trading Justice Podites. That's a terrible word for it. Teammates, we shall call it, since that's what we are here at Trading Justice. But I'm preparing a speech, not so much a speech, a training. And I was testing it out today, and I was talking to an amazing group. So I decided to record the speech and let my listeners out there see a little bit of truth regarding the 401k model, the traditional system of retirement, and how we break away and take control. So without further ado, this is a presentation that I was given earlier and thought you guys would enjoy it. How many of you are here to learn how to control your financial future? How many of you are here to learn how to control your financial future? I think we all are. Absolutely. In fact, what percentage of the human population wants financial control, wants financial freedom, wants to get out of the rat race? Everybody does. So what is different about you right now in comparison to everybody else? If we all want financial future, not everybody can control their financial future, ladies and gentlemen. That's not how money works. Okay, if everybody was rich, everybody would be poor. Money simply exchanges hands. What is the number one difference between you and everybody else out there? You're learning how, taking action, education, you're becoming more informed. I like all those answers. It's really actually quite simple for me. Okay, the rest of the population, they don't even know what anything is in terms of trading, investing. They don't even know what's in their 401ks, and they're not here tonight. You guys are here. You're investing in yourselves. You're investing in your time and your capital and your energy, and you're trying to make a difference in that capacity. And so that's what I see as the number one difference right now. Obviously, we got a lot to learn. We got a lot of techniques that we need to learn. We got to learn how to do everything. But before we learn how to do everything, we have to learn what we're up against. We have to learn what out there in the market is happening and what are these retirement models that are put out there. How many of you believe that the traditional system of retirement, including going to school, which is college, getting a job, having a nice little retirement account called a 401k, and retiring on a pension, Social Security, and that 401k is going to get the control that you desire? Now, it doesn't work any longer, does it, Brian? It doesn't work any longer. This is what we call the traditional system, ladies and gentlemen. The traditional system was created in 1973. It was released in 1976. What the traditional model replaced was that of the pension model. And what was going on is people were living longer. And what was a pension? A pension is a promise of the government or the corporation, whomever you have the pension with, to basically take care of you during your retirement. Well, as people were living longer and longer and longer, pensions were going bankrupt. And so you had to shift away from the old pension model, which put the onus of retirement on the corporation or government, and they shifted it to that of the individual because pensions were bankrupt. In fact, if you look at pensions today are over $2 trillion in bankruptcy already. We all know what happened in Detroit. We all know why they went bankrupt, and it's because their pension model went bankrupt. And so now that pension, what people were relying on, is no longer there. And that's one of the saddest parts about the pension model, is that even with people who do rely on a pension, it doesn't mean it's guaranteed to be there. Because if the corporation doesn't have the money, or if the government doesn't have the money, how are they going to take care of the pension in the first place? So we shifted away from this in 1973. The model, the 401k model is called the self-contribution model. And so instead of corporations and government taking care of people in their retirement, all of a sudden now the onus, the responsibility was put forth on the individual, and that's why it became known as the individual investment or the individual retirement account, because it's the individual that is putting money into their 401k, which is invested in mutual funds. And you can kind of think about that individual account, it's like a savings account that is invested in mutual funds. And then retiring on Social Security, that funds, it really doesn't work any longer. That doesn't mean it was always a dead model. Back when the 80s and 90s were going on, late 70s, 80s, and 90s, as the market was going up, people were making money in their retirement accounts. As the dollar was increasing in value in the 80s and 90s based on the petrodollar, basically you had people that were making money at their job. You had a complete, from 1982 until really into the early 2000s, you had an explosion in the U.S. economy. The U.S. economy had exploded unlike it had ever done in the history of our economic system. The dollar was very strong, but something shifted and something changed, and now the marketplace doesn't just go up, it actually cycles. Now the dollar doesn't go up because we no longer have the petrodollar, and the dollar devalues. And now we're still dealing with rates of inflation that are quite unbearable if you go to the grocery store. So even though it's a dead model today, that doesn't mean it was always a dead model. It might have been an inefficient model, but it was a model that was working to a certain extent. I want you guys to write this date down in time. And what this date is 1999. In 1999, we've seen a fundamental shift in how the markets behaved in terms of price action. That's technical analysis and market cycles. In 1999, we started to see the beginning of the death of the petrodollar. Now, what the petrodollar was just oil being priced in US dollars, which basically meant everybody in the world had to buy oil, and they had to first sell their currency to buy oil from Saudi Arabia and the Middle Eastern countries and OPEC in general. And so that started dying, so the dollar started declining, and the market cycle started changing. And now people simply can't retire. They do not have enough money to retire, and the money they do have devalues over time, and the cost of goods rises over time. One of the biggest problems with the retirement model is you don't know today how much money you're going to need in 2 years. You do not know today how much money you need in 5 or 10 years, because you don't know what the value of the US dollar is going to be, and you don't know what is going to happen based on inflation, and whether or not the horrific monetary policy of the U.S. Federal Central Bank is actually going to spark some degree of hyperinflation, and that becomes a dead model. So when I refer to this being a dead model, it's based on the underlying economic value of the dollar, inflation, and the market reaction and the market cycle. Let's talk about those 401ks. I'm going to ask a very simple question to the audience here. How many of you have a individual retirement account like a 401k? About 50% of them do. 50%. And Aldo says, I'll pass. Okay, when you look at it, TSP, government TSP, Jorge, that's very similar to that. There's 3 different types of accounts that people will trade. You have what is called a 401k, and yes, you can trade a 401k. You do not have to stick that in mutual funds. We'll talk about that here in a second. Number 2 is called an IRA. It's called an individual retirement account. You have more flexibility, the exact same tax-deferred status, and you can lower your taxable income with an IRA on a yearly basis as well. You can short stock in an IRA. You cannot in a 401k. You can trade credit spreads and option strategies in an IRA. You cannot primarily in a 401k. And then you have what is called an individual account. And all of these accounts are like a checking account of which we can trade in some capacities. I don't care what type of account you have. I care that you have an account. Now, how many of you have a broker? How many of you have a broker? Okay, good. And for those of you who have a broker, where do you broker? Where do you broker at? Fidelity? And when I'm talking about a broker, I'm not talking about the self-service broker. I'm not talking about the guy in smoking a cigar in some office in Chicago or New York. I'm talking about an online discount broker that you utilize to place trades with, like Options Express or Trade King or Scott Trade, Fidelity, E-Trade, Thinkorswim, TD Ameritrade, those types of companies. We're the ones who make the trades with them. All right. Now, you have two types of traders out there. You have what is called a passive investor. A passive investor is somebody who allows other people to manage their money. That is not what we want to do. That is not what I'm here to teach you how to do. That is like investing in mutual funds and having these massive institutions charge you way too much in fees to underperform the market when it's as easy as a click of a button to outperform what they are doing. The second type of trader you have is what's called an active trader, and that is somebody who controls their own money. They place their own trades, their own investments as well. You also have two types of brokers that market and tailor themselves to these two very different types of investors. You have what is called a active traders broker. That is like Thinkorswim, Options Express. That's like Options House, Interactive Brokers, TradeStation, Trade King, those types of brokers. Then you have the passive brokers. That's like Fidelities, and that's like your E-Trade, Scott Trades, those types of brokers. Which one do we primarily want to focus on? The active traders type brokers or the passive investor type brokers? Yeah, we want an active trader broker, ladies and gentlemen. And the reason we want an active trader and broker, because as an active trader, those types of brokers give us the tools and gadgets that we need to be successful. That doesn't mean you have to stop using Scott Trade or Fidelity or whatever the case might be. You can get a second broker to start an IRA in. You can get a second broker to convert a 401k into an IRA. You can get a second broker to start an individual account. I don't care how we do it. That's going to be very individual. Every one of you are very individual type of traders, type of investors. So what we have done is this week, every single one of you get a 60-minute consultation with one of my financial consultants to help you really determine those types of questions. How are we going to trade? Where are we going to trade? What type of trader are we going to be? Those types of questions. And so Tammy Farr is here to help you along the way in terms of answering any of your questions. And Tammy, if you would be so kind as to put your email address in the chat so everybody can send Tammy an email on the break to start the process of setting up that consultation, and we'll talk about that here in just a little bit. For right now though, guys, I want you to do some research, and I'm going to do some on my end really quickly, and I'm going to get you guys a link that you can start doing that research. And Barron's every single year puts out an article ranking the top brokers in the world, basically broker rankings. There we go. Let me see if I can get that link for you guys. Here it is right here. Okay, so tonight I want you to do some research, and I want you at the end of that research to pick one of those active brokers. Now we choose a broker called Thinkorswim. That's who I've been brokering with for the last 5 years. That's who my brother brokers with. That's who your mentors are going to broker with. That's who every one of us broker with. And that once again is called Thinkorswim. That's who we broker with. TD Ameritrade owns them. We do not get anything from Thinkorswim. We don't sponsor them. We just use them because they're the best options related broker in the industry. In your next classes, you will be using Thinkorswim in those classes as well, so that you can get to know that broker as well. Thinkorswim definitely does still exist, Aaron. It just exists as housed under TD Ameritrade. And so it's not its separate entity any longer. TD Ameritrade owns it, but we still use it as Thinkorswim. It's still called the Think Desktop. It's just owned by TD Ameritrade now. So can everybody select a broker by the time we start our class tomorrow? Okay, good. A couple things, guys. You do not need to fund the account to download and start testing them out. Brokers, these online brokers, they're just like a bank account. It's not stressful. It's not overwhelming. It's a checking account. You don't have to fund the account, and you can start virtual trading. You can start participating, and you can start applying what you're learning. Now, let's look at the 401k model, this passive investor model here for just 1 second. This individual right here, does anybody know his name? What was this guy's name? He was the father of Vanguard, the creator of Vanguard. He created the traditional system of retirement called the 401k model. His name was John Bogle. Yes, Ian, great job, John Bogle. John, there's a couple problems with this traditional system that we're going to talk about right now. Because again, guys, it is absolutely imperative that you understand traditional model systems of retirement, because it's that you're trying to get away from. It's that you're trying to diversify from. And if you don't understand what the traditional model is, if you don't understand the problems associated to the traditional model, then then it's very difficult to get away from that traditional model. The traditional model we're talking about is the 401k model, once again created in 1976. The first major problem with the 401k model is the fees associated to the model. Now, I am perfectly fine paying somebody money to do something that either I don't want to do myself or that I can't do myself. Would you guys agree with that? That we're fine paying people money to do things that we don't want to do or can't do on our own. Okay, I am perfectly fine with that. Well, according to John Bogle, in 2007, he wrote a book called The Little Book of Common Sense Investing. And he said, surprise, the returns reported by mutual funds aren't actually earned by mutual fund investors. Now, when you think about the mutual fund fees, when you look at all the commission fees, the fees to run the account, there's like 6 to 8 different fees that you're actually charged. And no, it's not 1%. It actually adds up to about 6 to 7% on the gains or the losses. They make that money if the market goes up or down every single year. Now, in terms of that, you're paying whatever you have in your retirement account, 6.5% of that yearly, to the fund managers, the institutions to manage your money. Now, again, I'm fine with that if your fund did better than the market. Would you agree with that? We're fine with that if the fund did better than the market. Okay, good. Well, if you look at kind of the total amount of fees, consumers pay, who are passive investors, consumers pay over $1 trillion in fees every single year. Now put that into perspective. In 2008, we went through one of the largest crashes we have ever been faced with in any market, any economic system. You literally gave up 100% of the gains that you made from 02 to 07. It was only about a year to a year and a half from the very top to the very bottom of the market. Our financial system in 2008 was utterly crashing. Bear Stearns is gone. Lehman Brothers is gone. You had to bail out the banks to the tune of trillions of dollars. You bailed out even insurance conglomerates like AIG and car makers like GM. I mean, we're talking literally one of the largest, nastiest, brutish, hawkish bear markets we have ever seen, and the speed of it was just completely overwhelming. Was that nasty? How many of you guys went through that? Was that nasty for you guys? It was painful, wasn't it? Yeah, and we do not want to repeat that, correct? How many of you do not want to repeat that? It's just such a nasty scenario. Unemployment spikes to 10% reported. I mean, we just don't want to go through this again. How many of you got just slaughtered in that market where you lost 50 to 60% of your retirement account? A lot of people did, and it's terrible to actually think about. And yeah, Ivan, it was worse. I mean, when you're talking about the tech bubble bursting, the S&P 500 only gave up 50% of the gains that it made in the actual tech bubble. When you're talking about the subprime bubble, it gave up 100% of the gains that it made in the subprime market. And the tech bubble took about 2.5 to 3 years to go down, versus the subprime market, which took, from literally the time it broke support to the time it found support at the end, was only about 14 months. And so it was absolutely nastier. Well, an estimated about $5 trillion came out of retirement accounts. It's like $5 to $10 trillion. Most put it into the $5 trillion range. $5 trillion. And one of the nastiest, worst things we've ever went through. And yet, over the last 5 years, those same consumers who have never want to repeat that again, who are still just recovering from it, have paid over $5 trillion to the same people that created the crash in the first place to manage their money. Now think about that for a second, ladies and gentlemen. But why aren't those same consumers, those same passive investors in retirement accounts and 401ks, why are they not all up in arms about the travesty of the banking system and Wall Street and financial institutions stealing their money? It's the same concept, because when a consumer makes anything above zero, when a consumer makes anything, they do not question it. They do not question it. If they make 10%, they're like, hot damn, I made 10% last year. I am a genius. Even if the market went up 30%. If they went up 5%, they say, you know what? At least I made money. And if they go up zero, they say things like, well, at least I didn't lose money. And if they went up 20%, they think they're the absolute most genius of the genius out there. And the market's going to go up like that forever. Okay? It's time to shift the way we think. Okay? Whatever we did in a retirement account last year in 2013, it is all relative. 10% isn't good if the market went up 30. 20% isn't good if the market went up 38. 5% isn't good if the market has one of the best years that it ever has had. You have to compare it against something. And we have to, like I said, guys, we have to shift. I'm here to tell you, it's time to cut the middleman out of the equation and take control for yourself. And that's what people like John Bogle says. That's what people like Warren Buffett says. That's what people like myself and Tim, my trading partner, that's what we're going to tell you. Another problem with this economic model, this traditional model, is the dollar. The strength of the dollar has declined by 35% since 1999. What that means is that your buying power has been reduced by 35%, which means you need 35% more today than you did in 1999. If you look at your retirement accounts from 1999 until 2013, they are not up 35%. Okay, they might be up 10% total after the fees. And after the fees, I'm willing to bet most mutual funds over the course of the last 15 years are about break even. This third major problem with this traditional model, the first being the fees, the second being the devaluation of the dollar, and the third being inflation. Inflation is the rising cost of the goods and services in a marketplace. Basically what inflation is you have inflation and then you have deflation. Inflation basically goes like as there's more money in the system, the cost of the goods and services will be more than other times. So we track inflation every single month based on two economic reports. One is called the CPI report. The second one is called the Producer's Price Index. It's called the PPI report. The primary one that we need to concern ourselves with is this one right there, and that would be the CPI report. Now, inflation by itself is just the rising cost of goods and services. Now, inflation is not necessarily a bad thing. Inflation at 2% is actually a really good thing. Inflation at 2.5% is a really good thing, because if wages go up at 3% and inflation goes up 3%, that means that we basically break even. But let me ask you guys a question. When was the last year that we saw an increase in wages in America? I want everybody to guess. When was the last year we saw an increase in wages? It was actually 1989. 1989. Since 1989, wages have been flatlined. Since 1989. So wages are flatlining in America, and yet the CPI report is showing an increase in the cost of those goods and services, which means we have to pay more money. When you look at the CPI report since 1999, you've had a total increase in inflation of 33%. That is an average of 2.3% yearly, which is fine if wages grow at the same rate. Wages are not growing at the same rate any longer. And so now, instead of, let's say for example, you had $100,000 in 1999. Based on devaluation of the US dollar and also based on the cost of the goods in the marketplace, instead of $100,000, you need about about $168,000 to purchase the exact same amount of goods. That's a typo. It's supposed to be 2014. So you need about $68,000 more per 100,000 units spent to have the same lifestyle. Okay. Now that number, the 2.3% yearly increase, it comes from the CPI report. The CPI report does not include a couple things. What are they? What does the CPI report not include? Yeah, it doesn't include gas, energy. Okay? It doesn't include food. And aren't those two costs two of the biggest costs to us as consumers in America? Isn't our food bill outrageous? Isn't our gas bill outrageous? Well, and taxes also have gone up, Dave. That's a great point there. Well, when you look at it, crude oil in 1999 was $15 a barrel. Today, that number is $86. It's actually around $80 right now. That is a 475% increase in the cost of oil. The food price index, okay, was which tracks the 5 basic food items in 1999. That was $84. Today, that's $237. That is a 183% increase in the cost of the goods and services. And just to throw it out there, the cost of education at all public universities in the U.S. has went up 73% in the last, and that was just in those 10 years. These are some of the biggest costs to us as parents, as consumers, as individuals in our society. And now you're starting to see why our dollar doesn't go as far today. Now you're starting to see why this retirement system is truly so damaged and so broken. And Balaj, why don't they make it part of the CPI report? Let me kind of explain that for a second. Have you ever heard of an individual by the name of Karl Marx? Yeah, he was an economics philosopher, right? 19th century. Karl Marx one time, he made a statement and he said it's the opium for the masses. Do you guys know what that means? The opium for the masses. Basically what Karl Marx said was that if you keep a populace ignorant, what can you do? As a government, what can you do? If a populace is ignorant, you can control them. Okay? It's the same thing Machiavelli said back in the discourse. He said that back in the 15th century. And so if you keep a populace ignorant, you can control them. Well, when you look at our economic reporting system, like the CPI report doesn't include food, it doesn't include energy, because if you include those two items, which have increased at such dramatic levels, okay, it will mean that the CPI report that is reported will be much, much, much higher than 2.3%. And if inflation is reported at 10%, what will people start doing? What will people in society start doing if the reported numbers is above those levels? They'll protest. I agree with that, Caleb. They will panic. They'll buy more silver and gold. That's the big one. They will stop spending money. That's what they'll do. And our economic system, okay, is based on consumer spending money. The American GDP number is $16 trillion. 70% of that is based on consumers going out there and spending money. So if you keep a consumer ignorant, they are easy to control, and thus they keep spending their money, which means the government keeps going and the corporations keep going and Wall Street keeps going. And that is what they care about. They do not care about us as the consumer. And like Roger said about unemployment, when you look at unemployment right now is 5.7%. What that doesn't include, though, is the people who are no longer receiving unemployment benefits. It doesn't include the people who are off the system. It also doesn't include all of the part-time jobs. It includes some of them. But in looking at that number, the real number is 17%. And once again, if the unemployment rate was actually reported at 17%, the real number, what would people do? They would stop spending their money. So going back to the Machiavelli or the Karl Marx or whatnot, what our entire system is designed to do is make you reliant on somebody else, number one, and keep you ignorant so that you can be controlled. And it is time to stop allowing them to do that. It's time to take back our control. Does that make sense, everybody? Yes, good. Okay. Here's what's happened to the US dollar and your purchasing power. It's called a buying power effect. When you look at your buying power, it goes to the devaluation of the dollar, and it also goes to the cost of the goods and services in our society. And as the dollar, and this is an actual chart of the value of the dollar over the last 100 years. Over the last 100 years, from the creation of the US dollar in 1913 until now, our purchasing power is about 4% of what the value was in 1913, with a tremendous decrease since 1999, with 35% decrease since then. And that's just your buying power. Now, another thing that the market, when looking at this traditional model of retirement, look at the movements. This is a S&P 500 chart from the 1980s to 1990s. As the market is going up, what do consumers never do? They never ask why they only made 8%. That they never ask that. They just say, well, if I make 8% for the next 40 years, I'm going to retire with enough money for to maintain my lifestyle in retirement. Well, we've had about 40 years of data in this traditional model, and how many people can actually retire right now with enough money to maintain their lifestyle? Very few. It's like 5%. About 5% can. For the other 95%, they can't do that because the market doesn't just go up. The market now is cycled. It bubbles up and it crashes down. It bubbles up, it crashes down. And my brother Tim, my trading partner, will be on here in just a little bit, and he's going to talk to you guys about the market cycle and what creates this market cycle and how we can take advantage of this market cycle. Now let's get into kind of taking control for ourselves. Now, a couple things. Number one, if you can learn to break away from this traditional model, outperform whatever your retirement account has done for how many ever years it has done that, starting right now, would you call this training a success? I'm talking from right now moving forward. Cutting out the middleman, not paying them fees, hedging your risk, everything. Awesome. Because that's the standard I want to set, guys. I want to set that standard of outperforming 90% of mutual funds. I want to set that standard of every single one of us controlling our financial future and getting out of the rat race. That is my standard. 90% of mutual funds. And what mutual funds are is it is a basket of stocks. 90% of mutual funds underperform the S&P 500. Now, when you look at the marketplace, there are four major market indexes. You have the S&P 500, you have the Dow Jones, the NASDAQ, and the Russell 2000. The Russell 2000 is kind of like small and mid-cap stocks. Your two blue chip indexes are the Dow Jones and the S&P 500. Now, it is the S&P 500 that we use as the barometer about how the market did. The reason we use the S&P 500 is because it gives us a better barometer of the health or of the economic condition. We used to look at kind of the Dow Jones, and it was the Dow Jones historically. Why do we no longer use the Dow Jones? The Dow historically is industrial. It tracked the economic standing for the better part of 70 years. It's only 30 stocks, good, but it doesn't track the economy today. For example, are we an industrialized economy or are we a service economy today? Yeah, we're a service economy. So in terms of being a service economy, the Dow, which is an industrialized blue chip index, doesn't track what the economy is today. Does that make sense, everybody? Okay, good. So when we talk about the barometer, you can ask Miles Elwood. Please stop hurting everybody else's time, because everybody else here is trying to do better. Everybody else here wants to learn how to do this. And if you can't learn how to do this in 45 minutes, I apologize for that. But yes, you can certainly get your money back so everybody else can move forward. I think everybody would appreciate that. Now, in terms of the S&P 500, the S&P 500 is the 500 biggest stocks in the world. They're not just U.S. economies, a U.S. economic system any longer. It is a global marketplace. Now, what Warren Buffett said in 2013 was if you invested in a very low-cost index fund, you'd do better than 90% of investors. Just pick a broad index like the S&P 500. When you look at the entire marketplace as a whole, the entire marketplace is actually tracked. We can invest in that. Now, many people do not understand that we have these things called ETFs. They're a creation of just the last few years, probably the last 5 to 10 years. There's thousands of ETFs. ETFs stand for exchange traded funds. Okay, think about ETFs like a mutual fund, but they trade like a stock. Mutual funds do not trade during the day. ETFs do. You can trade options on ETFs. You can sell covered calls on ETFs, which we'll get into trading option strategies and building cash flow tomorrow when we do our options presentation. Now, of the four major indexes, you have an ETF that tracks each one of the indexes. For example, in the S&P 500, you have something as referred to as the spiders. It's the symbol is SPY. In the Dow Jones, you have an ETF called the diamonds. It is DIA. In the NASDAQ, you have an ETF called the Qs, QQQ. And in the Russell 2000, you have an ETF that I like to trade called IWM. And so what Warren Buffett basically says is this. If instead of investing in mutual funds, you take that money, you convert it into an IRA, and then you put that money into the spiders, all of a sudden you are doing better than 90% of the mutual fund marketplace. And you're not paying the fees to the institutions that you're doing right now in your retirement accounts. Now, how many of you have ever converted a 401k into an IRA? Okay, Sandra has, Cynthia has, Kurt. Okay, good. For those of you who have actually done this, is it a difficult thing to do? Is it a difficult thing to do to convert it? It's actually really simple, guys. Okay, it's actually very, very simple. When you're looking like, for example, let me show you kind of how this whole thing works here. Let me share a whiteboard. Let me see if I can get some drawing tools. They changed the drawing tools on us, so just bear with me for just 1 second. Actually, I'm not going to do that because they don't have my drawing tools there. Okay, now, let's say we have two individuals. you have one individual, and let's track 2013 for a second. Really good year in the market. In 2013, the S&P 500 went 30%. So for those of you who had a 401k in 2013, how well did your 401k do in terms of the percent? You have three types of them. You have aggressive funds, defensive funds, and you have bonds. Okay, Rudy, I'm willing to bet you were an aggressive fund, correct? Yep, you were an aggressive fund. Good. Anybody here have defensive funds last year? They went up about 8 to 10% last year. And then you also have what's called a bond fund. Bond funds basically went up 0 last year. So let's take a combination, and this is what a lot of people have. They'll have some aggressive funds, they'll have some defensive funds, they'll have this conglomerate. So let's say an individual has $100,000, and I'll type it into chat here so you guys can follow along. So the consumer who is invested in a 401k, they have $100,000. And they went up an average of 15% last year, of which they thought they did good last year. Okay, how much money did they make last year? Yeah, they made $15,000. And they make that $15,000, and since they made money, they're like, hey, I had a great year last year. All right. Well, let's say there's another individual out there that says, I want to learn to be an investor. And while I learn how to actively trade, I don't want to pay fees to this institution to manage my money. I want to manage my money and outperform the market. So that individual we'll call as an investor now. They have $100,000. And they simply put their money into the spiders in an IRA. So they call their broker, whomever that is, Thinkorswim, Scottrade, E-Trade, whatever it is, and they say, you know what, I want to convert my 401k into an IRA. The broker says, okay, I'm going to click a button. They put that $100,000 and they put it into an IRA invested into the spiders. Now, how much money did they make last year? $30,000. So what is the value of knowledge, even in that small example? What is the value of knowledge? It's $15,000. So the question that you have to ask your mutual fund manager, your advisors, where is my $15,000? Because that's how much money you basically gave them. And if you look at a lot of your mutual funds today, they're invested in things like the spiders, the diamonds, the Qs, IWM. They're invested in the marketplace itself. They're just doing it housed under a mutual fund, whereas you can do it housed under an ETF. Does that make sense, everybody? Okay, good. So let's talk about steps here. Okay, because again, understand this traditional model, understanding what the steps are. Step 1, get a broker if you don't have one. That's step 1. Step 2, choose a type of account. Now, in terms, yes, they do. They always outperform, Dave, mutual funds. And even in bear markets, Dave, you will lose less in the spider. Even as the spiders goes down 50%, you will lose less than the mutual funds because you still pay the fees. So next, in your broker, you want to choose a type of an account. Now, if you have a 401k, it's already in a broker somewhere. You got to figure out where it's at. Number 2, if you want to convert a 401k into an IRA, can you do that? Yes or no? You can. However, there's a couple caveats. If the 401k is at a current employer, you are very limited in what you can do with it. You can still use that money to invest with, ladies and gentlemen. You do not have to put the money into mutual funds, for example. You can still place trades and all of that. All right, you just can't convert it into an IRA. If your 401k is at a prior job, which is called an orphan 401k, you can convert that immediately into an IRA and start trading it under an IRA. Now, the importance of that is you still have the tax deferred status. If you pull the money out of the market, you're going to pay something that's called capital gains, and that's going to be 10 to 15%. And I know a lot of people who have done that to put the account into an individual account so that they can have more flexibility with their money. Any way we do it, right now, let's just start an account. Let's start taking that process. Does that make sense, everybody? Okay, and again, specifically, the personal step-by-step for you as an individual, since I can't go through the individual capacity of 39 different people, I want you to talk with my team this week. Every one of you have that consultation. Work with my team this week. They will help you put you on that proper path, so that starting now, immediately this week, we're starting to take control of our financial future. Now, while we kind of understand this, let me explain kind of how this process works in terms of what the market is. When we refer to the market, a lot of people first have the question of, well, what does this mean? What does it mean when he's talking about the market? Well, it's actually something we refer to as the top-down approach to the market. Now that we understand the major market indexes and whatnot, let's understand what the entire marketplace is. I'm going to go ahead and share my screen here and let me know when you can see it. Okay, good. Now, in terms of the marketplace, you have four major market indexes. It's the S&P 500, the Russell, the Dow, and the NASDAQ. Now, in the S&P 500, right underneath the S&P 500, you have something that is called a sector. How many of you have heard of sectors before? Okay, good. In the S&P 500, we're going to categorize 9 sectors. There are some aggressive sectors. There are some defensive sectors. What an aggressive versus a defensive sector is it goes to the heart of consumer spending. Remember, the U.S. economy is a very large economy. It's the number one economy in the world, and it is a $16 trillion economy. 70% of that is based on consumers spending money. Now, when consumers are happy about their retirement accounts, when they have a job, when the markets are going up, what are consumers doing with money? Yeah, they're spending it. They live paycheck to paycheck because they say to themselves, hey, if I spend all my money today, I know I'm going to get another paycheck in 2 weeks from now, which means they're going to go out there and they're going to buy that new iPad. They're going to buy that new iPhone 6 because their iPhone 5 isn't working. They're going to buy the new computer. Governments are going to have more taxable revenues as well. So they're going to be spending on infrastructure and roads and bridges and whatnot. Every single entity in the market is spending more money, and thus aggressive sectors will typically go up faster than defensive sectors. You have 5 aggressive sectors. 5 aggressive sectors. The first one, and if you look over here, the first one is something called consumer discretionary. Now let's go ahead and look at this on a weekly chart here so we can kind of chart it a little easier. Tim will talk to you guys about charts here in just a little bit. So this is consumer discretionary, still a bullish index, okay, in discretionary. The second one is energy. Is energy bullish any longer? And can somebody tell Ivy to relog, please? Just take a second to tell Ivy to relog, since Ivy can't hear me at all. No. This is not a bullish sector. In fact, this is a bearish sector right now. Energy is is the most bearish sector in the marketplace, and I'm looking to get back into short trades on the energy sector here in just probably coming fairly soon. The next aggressive sector is industrial. Industrial looks very similar to that of the market does. It also looks similar to discretionary, as you saw this one. Then you have technology. Technology, once again, looks very similar to the rest of the market. And then you have, so we have technology and basic materials. And basic materials is basically starting to form a reversal pattern. okay, a reversal pattern. So in your aggressive sectors, you have 3 aggressive sectors, okay, that are some degree of bullish. You have one sector that is already bearish called energy, and you have basic materials that is starting to double top. We do not know if it's going to be a reversal yet. We do not know if it's just a lull, but what we do know about basic materials is it is underperforming the marketplace. And then you have the defensive sectors. When the markets get a little scared, when people in the markets get scared, when institutions get a little nervous, what do they do with money? Maybe not institutions, but when people. Yeah, they hold back, right? Because when they start getting scared about the future, they start making the emotional connection to stop spending money. They make instead of buying the iPhone 6, they say things like the iPhone 5 still works, and they might as well just utilize that. And so they start pulling back on their spending. But do they still spend on food? Yes or no? Yeah, they do. And that's this sector called consumer staples. Consumer staples is one of the best sectors in the marketplace right now. Do they still spend on healthcare? Yeah, they still take their kid to the doctors, right? Healthcare, one of the best sectors out there. And utilities, do they still pay the utility bill? Yes, they do. Okay, and here's financial, which financial, typically they would still pay the money, they would still spend the money on their mortgages and whatnot. That did change in 2008 to a certain extent. So when I'm looking at the sectors right now, we analyze sectors for a couple reasons. Number one, if a sector is doing really good like healthcare and consumer staples and industrial and technology and utility, those are probably your 5 best sectors. That will mean a lot of the stocks in those sectors are also doing good, which means we might want to look for buying opportunities there. Does that make sense, everybody? Okay, good. And if you have sectors that are doing really bad or not as good as the market, that might mean there's some stocks in those sectors that are not doing as good, which means there might be some selling opportunities, which is called shorting. Now, does everybody understand what shorting stock is? Does everybody understand shorting stock? Yeah, okay, let me explain the concept real quick. For every transaction in the financial markets, you have a buyer on one hand, you have a seller on the other hand. When you are buying a stock, this strategy is actually called long stock. And so you buy a stock, and how do you make money? What has to happen to the stock for you to make money when you buy the stock? No, Dave. I'm sharing my screen in Mock Trader. Yeah, it's got to go up, right? It's got to go up. Okay, good. When you short a stock, so you buy a stock, did somebody in the market have to sell that stock to you? Yes, somebody had to sell it. So for every transaction, you have a buyer and a seller, okay, for every single one. Now, when you buy a stock, you buy it first. To close the trade, you then sell it to close. So you're the buyer first, then you're the seller second. When you short a stock, you are now the seller first and the buyer second. So when we short a stock, we are simply the seller first. Now, in terms of shorting stock, how do we make money? As it goes down. As it goes down. So when we buy a stock, we make money as it goes up. When we sell a stock, we make money as it goes down. Now, shorting stock, what it is, the actual definition, it is the sell of a borrowed security. We're going to sell the stock to somebody else. We're going to borrow the stock from the broker. We're going to profit as that stock goes down. So if we sell a stock at $100 and we buy it back at $90, how much money do we make? $10. Okay, this concept of shorting stock is actually quite prevalent in our entire economic system. In fact, you guys, even today, you don't even understand how much you participate in shorting stock. In fact, how many of you own stock in any capacity? Okay, good. Did you guys know you were already participating in the art of shorting stock? If you own a stock? Did you already know that? Okay, what happens is the broker isn't just going to borrow their stock. The broker is going to borrow your stock and borrow it to me. And I'm going to sell it to somebody else. I'm going to take something I don't own. The broker's going to take it from you. I'm going to sell it to somebody else. Think about that one for a second. Also, how many of you have a checking or a savings account? You're participating in shorting stock. When you put money into a checking account, what does the bank do with your money? They loan it out. They sell it to somebody else. So the bank is taking something they don't own. They're going to borrow it from us, sell it to somebody else, and when we want to go get the money out of the bank, unless you live in Cyprus, you're going to get that money out. How many of you ever purchased something from an infomercial or Amazon or anything like that? Guess what? You're already participating in shorting stock. You're going to buy somebody from Amazon, for example. They're going to buy it from China, deliver it to you at a later date. They're just the drop ship. Okay, or an infomercial, same thing. We participate in this concept of shorting stock literally all the time, every day. We just don't put it into that terminology. So now do you understand what this concept is a little better? Awesome. Okay, good. So that's the first thing. When I'm looking at these defensive sectors or aggressive sectors, it helps me determine if I want to, what sectors are the best, because now I can go look at some stocks in those sectors to buy. It helps me determine what sectors are the worst, so I can go find some stocks in those sectors to short stock in. So that's number one. And probably more importantly is number two. It's something that's called sector rotation. You might have also referred to it as a flight to safety as well. In terms of that, when you see defensive sectors outperform aggressive sectors, what does that tell you about the market's mentality for the future? When defensive sectors outpace aggressive sectors? Nope. Money is moving. It's bad. It's the Wall Street financial institutions. They are getting defensive. They are flying to safety, because if they were not worried about the future, they would never take their money out of aggressive sectors, because aggressive sectors outperform, which means they would make more money. We're starting to see the defensive sectors really pick up strength right now, because money is flowing from aggressive sectors into defensive sectors, as Wall Street is trying to tell you they're getting prepared. And what are they getting prepared for, ladies and gentlemen? The next cycle. The next drop. And that's what Tim is going to talk to you guys about over the next hour, is he's going to talk to you about market cycles and why these institutions are doing what they're doing. And he's going to talk to you guys about trends and patterns and support and resistance. You guys are going to go out there and find a couple case studies on long stock, short stock, and as important as anything, you're going to identify how to spot a reversal off it tonight. You've been listening to a nice little speech presentation I gave a little bit ago, and wanted you guys to I thought it was a good topic to send out there to the universe. 401ks, controlling your future, the problem with the 401ks, the fees, the devaluation, the inflation, the underperforming, pretty much just the overall, disaster that is given your control to Wall Street. Time to take it back a little bit, ladies and gentlemen. So I wanted you guys to kind of hear that a little bit, those concepts as well. And we'll do that again. You've been listening to the Trading Justice podcast. Check us out on iTunes, Trading Justice on iTunes. You can subscribe to the podcast to get all future episodes of it. You can also rank the podcast. Nice little 5-star rated podcast here.
You've been listening to the Trading Justice podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.